We're going to have some great information. Obviously.
Wow. Turbulence is the price of admission for greatness. How's that for a quote for Mark to end on? It really is a telling thing that actually it was in one of Doreen Walsh's videos, the training videos. She said, for everybody who ever second guesses themselves about how much you actually know, remember that you know at least 10 times more than your clients do. So reach out to your clients, as Mark said, because absolutely we do need that director of warmth at this time. As I mentioned earlier, how lucky are we to have Shelly Kaushik with us here today on such a day? Like, you know, it's always a good thing to get an economic update, but in turbulent times like these, we need guidance more than ever. And Shelly joined BMO Economics in 2020, and she conducts research on the Canadian and regional economies. She also provides support on fiscal policy and on country risk analysis. Prior to joining BMO Economics, Shelly worked on fiscal policy at the Department of Finance Canada. She holds a bachelor's degree in economics from the University of Waterloo and a master's degree in economics from Queen's University. Ladies and gentlemen, please join me in welcoming Shelly Kaushik to the stage.
Hi, everyone. I'm going to stick to this just because you probably can't even see past my head if I'm on the podium here. Yeah, things are a little bit crazy right now. Haven't been sleeping too much over the last couple of months. Yeah, like Mark touched on, a lot of what I'm going to be talking about is tariffs. Hopefully, I'll be slightly more interesting than a high school econ teacher, but I will do my best regardless. So a lot has happened. Of course, we've heard a few allusions to Liberation Day yesterday. Essentially, what the United States president announced yesterday was a 10% import tariff on all imports except imports from Canada and Mexico. From any other country into the United States gets hit with 10% starting on April 5th. That 10% number will go up by a lot for a number of countries. If anyone has seen the pictures or the memes of President Trump holding that Bristol board, there's a list of countries in there. There's like 4 or 5 of those Bristol boards. So there's a number of countries that are going to have even higher tariffs starting on April 9th. So it's a pretty quick turnaround, and it's looking pretty bad for a number of countries, particularly in China, a number of Asian countries as well. European Union also dealing with some pretty hefty tariffs. Thankfully, again, Canada and Mexico weren't in the spotlight yesterday, but we've certainly been in the spotlight for a number of months at this point. So again, we've had a lot of yo-yos, a lot of delays, repealing of these tariff announcements for Canada. But as things stand right now, we have a 25% tariff on all autos and auto parts going into the United States. That actually gets lowered for every single part based on how they determine whether or not it was made in the US, and Mark touched on this a little bit. It's really, really hard to figure out exactly what specific part is made in the US because for the last 50 or so years, we haven't actually had a US auto manufacturing industry. We haven't had a Canadian auto manufacturing industry or Mexican auto manufacturing industry. It's a North American auto manufacturing industry. And so there isn't even a way to determine exactly how much of each auto part, let alone a car, is made in the United States. It's just whether it's made in North America or not. So that is for the trade lawyers and auto experts to deal with, but that is what we're looking at. We're also looking at a 25% tariff on steel and aluminum coming from any country into the United States. But as we touched on, Canada is the #1 foreign exporter of both steel and aluminum to a much larger degree to the United States. We also have a 25% tariff on all exports coming from Canada to the United States that are not compliant under the USMCA. That is a whole other legal gray area of what exactly is compliant, but that is what we're looking at right now, except for energy, potash, and some critical minerals, which are tariffed at 10%. So again, there's a lot there, a lot of categories. Basically, we have some tariffs in Canada on the United States. we actually kind of were able to, sidestep a lot of the announcements from yesterday, but we do have some indications that there are going to be additional tariffs soon, who knows when that will be, on specific industries like lumber, which will affect Canada again, things like semiconductors, things like that. Again, don't know exactly what that will be, when that will be, but we are keeping an eye out on the news. So Canada, for its part, has announced a number of countermeasures, the biggest one being counter tariffs of 25% on a total of $155 billion of imports from the United States. Now, so far, about $60 billion of that total $155 billion has actually been put in place. So if you're, shopping for clothes, if you're shopping for very specific items, it's like very, very specific on the Department of Finance Canada's website, you will see that 25% tariff if you're getting it from the United States. There's a number of non-tariff measures as well, and actually the Prime Minister is going to be speaking in about half an hour, so he might add some more. Don't know yet, but all that to say it's a very, very fluid environment. That means things change not just by the month or by the day, it's literally by the hour, by the minute. By the time I stop talking, things could be very, very different. Actually, on that note, if the tariffs get lifted while I'm talking, someone please stop me from talking. We'll all do a little happy dance together. But yeah, as things remain quite uncertain, there are a few, major points to keep in mind for all of us. Number one, uncertainty. That's the name of the game. I'm going to be saying that a million times throughout this presentation. But also, it's very important to remember, and Mark touched on this as well, that the impact of tariffs is not going to be uniformly felt across industries or across regions. And the best example that we've seen has been Canadian crude oil. And like we mentioned, there are very, very few substitutes for US consumers of Canadian crude. They either can't get it cheaply or they can't get it to the same grade. And so that means that Canadian oil producers are better able to actually pass those costs along to their American consumers. The US knows that, and that's why they put Canadian energy at just a 10% tariff versus that 25% on everything else. But on the flip side, again, autos gets talked about a lot, especially here in Ontario, because it's so important. But again, it is absolutely impossible right now for automakers to figure out what to do. So we've seen that announcement by Stellantis this morning, shutting down their Windsor plant for 2 weeks. That could last much longer, or again, it could end in 2 weeks. We don't know. But essentially, in the short term, a lot of automakers right now are trying to figure out whether we should or can even operate at the moment. Over the medium term, they're trying to figure out, okay, how do we actually figure out what the tariff is on our parts and on our autos, because we, again, have to figure out exactly how much of this little piece was made in the United States. And then over the long term, yeah, there is some incentive now to bring more production back into the United States, which is, again, President Trump's goal. But that requires a lot of time, many, many years. It requires billions of dollars in investment. And most importantly, it requires policy certainty, which we don't have right now. And so that is, again, another very major challenge for the auto industry in particular, but a lot of manufacturing industries. We hear about things like textiles also going across the border a number of times in the supply chain. And so a lot of business owners right now are thinking about those exact questions right now. So that all ties back to uncertainty. And unfortunately, uncertainty is not very good for the economy. And here's where we start talking about our predictions. These will change. In fact, a lot of my colleagues right now are in the office trying to figure out exactly how to change these. But as of right now, we have kind of our pre-tariff forecast, and we have to make some assumptions. We have to write something down in our baseline forecast. So we have this post-tariffs forecast. That underlies a lot of assumptions. It's kind of the first look. It will change inevitably. How it will change, I can guess, but I can't tell you accurately, unfortunately. So you can see that there's a very, very sharp drop that we have in the outlook for Canadian economic growth. And in fact, right now we are calling for a recession in Canada in 2025. So we are expecting growth to contract in both the second quarter and the third quarter of this year. And for the average 2025, we're looking for growth at just 0.5%. That's not great. Again, those exact numbers may change, but the overall overarching kind of idea is that's not good. In 2026, we are expecting growth to be at just 0.5% again, but that assumes that the tariffs will be lifted in 2026. That is one of the major questions. When exactly will tariffs be lifted? We are penciling in mid-2026 just because that is when the USMCA is kind of scheduled to be renegotiated. That could happen earlier. It is one of the many theories out there that the tariffs are being applied on Canada and Mexico as, to provide additional leverage for a better deal for the United States when they renegotiate USMCA. And so if that is the case, we don't exactly know if that's the case, if that's the driver. But if that's the case, then you can expect some of this tariff rhetoric to be kind of eased off in the middle of 2026. But like I said, could be later, could be earlier, we don't know. Now, we touched on this a little bit, but tariffs, what they essentially do, they raise prices. By how much, it depends on the industry, depends on the consumer, things like that. But they do raise prices, so they raise inflation. They also lower economic growth. So raising inflation, what does that mean on net? That means the Bank of Canada would be more hawkish, which would mean that interest rates would remain higher because they're trying to bring inflation back down to target, similar to what we saw during the pandemic. But if GDP falls, and to the extent that we're expecting into a recession, that would lead the Bank of Canada to try to cut rates even further. So they have these two kind of pressures right now. One, keeping interest rates high or even raising them, and one, to lower them even further. So on net, we do think that the economic impact will be higher or larger than the inflation impact. But again, not everyone agrees with that. And frankly, only time will tell. But on net, we do think that that will push interest rates down further. So we did have the Bank of Canada previously, before tariffs, we did expect them to have started to slow down the pace of interest rate cuts by now and get to a terminal rate of 2.5%. We're at 2.75% right now. So we didn't expect much more easing, but then after, again, this expected recession now in play, we are expecting the bank to continue to cut until they hit 2%. And like we touched on earlier, there's a lot of numbers out there, a lot of different forecasts. Not everyone is at 2%, but there are a lot of differing assumptions underlying those forecasts. And so that kind of gets back down to the fact that there's a lot of uncertainty out there. Everyone's forecast is a little bit like it's equally valid in the sense that there is a huge range of possible outcomes. So that's where we are right now. Again, in flux as I speak, both just what's happening right now in the world, but also just at our shop in the economics department. So all of that leads to weakness, it leads to uncertainty, it leads to a lot of confusion. That leads to weakness in the Canadian dollar. So this third graph over here, so this is showing the Canadian dollar in Canadian dollar terms. So if the line is going up, that actually is more weakness. And you can see that we have it going up even further. So we have it weakening even more than we did before the tariffs. That's partially because fewer people are going to want to buy Canadian goods. So they're going to need fewer Canadian dollars to buy those things. But also this broad kind of shift in certainty means people are flying away from risky currencies. They're going to the US dollar or other safe haven assets like the Japanese yen, for example. And so again, that all devalues the loonie. But like Mark also touched on, that's actually kind of good for Canadian exporters. So it can make Canadian exporters or exports look slightly cheaper. So it can absorb some of that impact from the tariffs. Now, what's actually going on in the economy? I did touch on the fact that it's a very different impact from tariffs depending on what sector you're looking at, but also just because of the way that this country is structured, it's very different depending on which province you look at. So this is just one of the ways to look at exactly how vulnerable each province is to these tariffs. So this is literally just a measure of goods exports to the US as a share of each province's economy. GDP. And you can see right there, Alberta stands out quite significantly. They send a lot of their goods to the United States. But another reason is a lot of what they send, in fact, almost all of what they send is energy products. And because energy, I talked about this earlier, is a little bit more insulated because they have a lower tariff rate, but also they have a better ability to pass those extra tariffs on to their consumers, they're a bit more insulated. So if we take off energy, so take off that green chunk over there on each bar, it's looking like central Canada is actually the most vulnerable. Unfortunately for us, Ontario, of all of those provinces, does look the most vulnerable to these tariffs. That's because we have such a strong manufacturing presence here in Ontario, especially, again, with the autos. So not great news here in Ontario, and that's actually why we expect Ontario's economic growth to actually, or Ontario's economy, sorry, to contract this year. Again, these numbers might change, but I think the big picture kind of remains. Alberta is looking at the top of the pack, the strongest economy, and that theme will flow through to a number of areas in the economy, but Alberta is looking to lead the way. Ontario is unfortunately lagging a little bit. Now, if we look at the country as a whole, when we're trying to talk about, bright spots in the economy, it's actually looking pretty good for Canada, or at least it was before the tariffs. Canada is actually coming into this whole trade war in a pretty decent spot. A lot of that is because Canada's economy and Canadian households are some of the most interest rate sensitive in the world. And we saw the downsides of that in 2022, 2023, when rates were going up at a crazy pace that we hadn't seen in generations. And so a lot of consumers pulled back on their spending. Everything was too expensive. They did that very quickly, a lot more quickly than a lot of other economies. And so that's why we see that blue line kind of flatlining during those years, because economic growth essentially came to a halt. It stagnated. And now we're seeing the flip side of that as rates started falling in 2024, take some time to actually flow through to people's decisions and businesses' decisions. But actually by the end of the year, we were seeing a decent amount of momentum building in consumer spending. People actually responding to the fact that rates are getting lower, and businesses responding to that, producing more economic growth, firming up. But again, the fact that tariffs are here and have such a large impact on our economy, so much of what we do on an everyday basis is related to the United States. It overwhelms everything. And so that's where we get to this prediction of going from pretty strong, building momentum, to now looking at a recession very starkly, unfortunately. What does that mean for the economy and for people? Well, the job market actually hadn't been looking too great. When we talk about jobs, it is important to remember that the job market is a lagging indicator. That's what we call it in economics. But basically, it takes a very long time for example, a change in an interest rate to actually affect decisions made by businesses, the demand that they face, all of that stuff to change and to actually change their hiring or firing decisions. So it takes a very long time. So the data that we're seeing in the labor market often reflects things that happened months or quarters ago. And so we can see that we just have the unemployment rate here. The unemployment rate went up. It was actually quite tight. It was pretty easy to get a job for a job seeker during the pandemic or right after the pandemic. But that quickly started loosening. Again, as rates started rising, it took a very long time. Jobless rates started going up and up and up, started building that slack. It becomes harder to find a job for someone who's looking. But also, we had very, very strong population growth here in Canada up until the end of last year. Population at its highest was growing over 3% year over year. That's the highest rate of growth since the baby boom. So that was a huge shock to the Canadian economy. And that meant that a lot of people are coming into this country. The economy just can't keep up by creating enough jobs to keep pace with the number of people looking for a job. So that necessarily means that the unemployment rate was also rising because of that as well. So we are at this point now where the unemployment rate is not looking too great. It's not terrible, but it's not looking too great. We essentially say the labor market is in slack or it's very loose. So again, it is very hard to find a job. But again, you can see after that forecast line, we are expecting that to get worse. And again, that is reflecting the fact that we are expecting a recession this year. I will just point out, I think the table is a little bit jumbled up right now, but if you can follow the colors of the fonts, we do have Canadian unemployment rate. So I'll just read out the numbers at 6.6%, but in Ontario, the jobless rate is actually much higher at 7.3%. And in Toronto, they're at the bottom at 8.6%. So Ontario's jobless rate or labor market has deteriorated much faster than the national average, and Toronto's even faster than that. So it's not a pretty picture, and you can see that in a number of areas in the economy, like in the housing market, which is what y'all care about. There's of course, we're coming out of the pandemic, which is like this once in a lifetime, once in a generation shock to everybody. And then now we have this once in a lifetime, once in a generation shock in the form of a trade war. So coming off two very crazy periods. I'm in the middle of one right now, but essentially, we know that after during the pandemic, I should say, a lot of people are trying to move away from those downtowns, from those big cities, right? They're trying to work from home. They're trying to look for, more affordable places to live, right? And so that caused a lot of demand in those more affordable regions, right? So whether that's the suburbs, exurbs of Southern Ontario, trying to move out to the Londons, the Windsors of the world, or fully moving back to maybe Atlantic Canada or to Alberta. So we're seeing, so this is kind of a way to show price changes from the peak. So the peak of prices in February 2022 to now February 2025, which is the latest that we have that data. So in 3 years, you can see that a lot of those pandemic trends are still continuing in the sense that a lot of the places in Canada that are still seeing that demand, that strength in price increases, Newfoundland and Labrador, Moncton, Calgary, PEI, are they as affordable as Toronto? No, but those prices are rising, right? Because people are still looking to move into those areas. On the flip side, though, one thing from the pandemic that has come off, nobody wants to live in Kitchener-Waterloo, in Hamilton, in London anymore. Why? Partially because prices rose so quickly in 2022 that now it's just, again, unaffordable, right? And so we're seeing that that froth kind of come out of those areas right now. Another way to look at that, market balance by region. So we touched a little bit about on what exactly is a buyer's market, a seller's market. Nationally speaking, we would say the Canadian housing market is kind of in balance right now, which is not something we've seen in a very, very long time. I'm a younger millennial, and I remember my entire adult life, literally since high school, everyone was like, the Toronto housing market's going to crash. It can't be so strong. Can't be that strong. Can't be this strong. Going on for decades. We are now in a position where the housing market has not crashed, thankfully, knock on wood, but we are still dealing with what is now essentially a buyer's market, and it is by this metric. So again, nationally balanced, but it really depends on where in this country you are. So up at the top there, we have these kind of more, these tighter markets. So again, the Calgary's, the Edmonton, so Alberta, dealing with both the fact that it's more affordable than Ontario, but also the fact that Alberta's economy is looking pretty good right now, right? So that's bringing a lot of people to Alberta, but also, again, Quebec City, you see it at the top there. Montreal is also at the top. A lot of these markets in the province of Quebec also tightening up quite significantly. And then again, at the bottom there is a lot of Southern Ontario, including Toronto. We actually got the numbers for March for Toronto this morning, as if there wasn't enough news out there this morning. And it's looking to go a little bit further down as well from this graph. So looking to soften even further. Now, if we zoom into Toronto, Toronto's really a unique case, not just because it's arguably the center of the universe in Canada, but also because it has a lot of factors, unique factors kind of encircling it. So one, we've talked about, yes, a lot of people left Toronto. To some degree, they're coming back to places like Vancouver, but they're staying out of Toronto because, again, that affordability picture is still quite challenged in Toronto. When we look at the GTA, and I think you actually showed some version of this graph already, so I won't touch on it for too long, but essentially showing that activity still remains quite subdued, because that affordability picture is so difficult right now. And when we talk about affordability, there's a lot of ways to measure it. Again, as a millennial, I like to think that when things are bad, they're the worst they've ever been, because no one else could have possibly had a worse, affordability crisis or a worse housing crisis than we have. But in fact, that's not the case. So affordability, yes, it was at or near an all-time high, depending on how you look at it again, in 2022, 2023, when rates were really high and still rising. We had actually mortgage payments on average, this is for the whole country, taking up just over half of household income. And so again, that was stretching household budgets a lot. That's why they stopped spending on things, right? That's come off the peak a little bit, partially because, yes, rates are starting to fall, but also because incomes are basically outpacing that. So if your income is rising, but your mortgage rate isn't rising, or mortgage payment isn't rising as quickly, that's putting some pressure off of you, off of your household budget, right? And you can see there that we do expect some improvement, but we're not expecting affordability to come back down to kind of normal levels anytime soon. And again, that's a result of the fact that we are expecting a recession. So incomes are going to slow down quite significantly in that kind of scenario. So you can see how much of the way that we look about the way we look at the economy is related to this kind of recession forecast, is related to the tariff forecast, how much of that is actually underpinned by what's going on in the United States, what's going on with Canada's response to what's happening in the United States. It is all very complicated, unfortunately, all very uncertain right now. But if we try to look ahead, essentially we're kind of expecting slow and steady, which again, we haven't really seen a lot of in the Canadian housing market for the last few decades. Slow and steady is good in the fact that it's slightly more predictable. It's definitely not a crash. It's definitely not a bubble. So, looking pretty healthy. We're looking at, a slow and steady recovery in prices and in demand as some of that pent-up demand comes back onto the sidelines. But I'll just point out housing starts. When people talk about the housing market, especially lately, there's a lot of argument and a lot of disagreement amongst economists on whether we have a supply shortage or whether we have a demand imbalance, like what is actually at fault here. The answer is really kind of both. It's both demand and supply. But essentially what I want to point out here is housing supply reached record highs just a few years ago. But the problem is that was partly during the pandemic when it took a very, very long time to complete an actual project because of those supply chain issues. So we're seeing a lot more things come online in terms of supply, but in terms of actually starting a project, a construction project, that has been coming off. Partially because, again, we have a lot of supply already. One might argue we have too much supply, for example, in Toronto condos. And so a lot of builders are pulling back. They're pulling back despite the fact that a number of governments at all levels of governments have promised to, double the pace of housing supply. We're hearing a lot of those kinds of promises during the election campaign. But the fact is that politicians and policy can't really dictate something that the market at the end of the day dictates. And the fact is that rates remain elevated even though they're falling. They're not back to where they were during the pandemic, if they even get there. The fact is that there is already this existing glut of inventory out there. And so why would a builder continue to build, right? So that's essentially why we expect this downturn in housing construction to continue. Now, I've touched a little bit on population, and population was actually probably the number one topic in the Canadian economy up until the tariffs started. There's a lot going on with population. Two main factors here. One is international population. That was really why population grew so quickly, right? It wasn't because we were all having so many babies. It was because people were coming from outside the country, right? The biggest chunk of that were non-permanent residents. The biggest chunk of that were international students. That is important, and I'll get to that in a second, but that's important to remember is that was the overarching driver of this whole population story up until the new federal immigration targets came into place starting last school year, so fall of last year. But there's another interesting thing happening, and I've kind of touched on this when we're talking about the housing market. Within the country, people who are here already, again, leaving those more expensive areas for those relatively cheaper areas. And so the biggest kind of cost in terms of who's actually where people are leaving from is Ontario, because as a province it is the most expensive province to live in, and to some degree BC as well, but to a much smaller degree. Where are they going? They're going to Alberta, to some degree also the Atlantic provinces, again those cheaper areas. And so that's where you see that picture of that regional variation in housing market and housing market outcomes coming into play. It's because people again are getting up and leaving. But like I said, that got super overshadowed by that international story. That international story, though, is interesting when you start talking about housing, because the non-permanent residents who were coming here and are here right now, the international students that are here right now, they're not necessarily looking to buy a house, right? They're looking to rent. And they're also not looking for a large house necessarily, especially those students. They may be packing a number of people into a smaller place, but they are generally looking at smaller houses or condos. And so this is why we see such a strong correlation between recent population growth and rent prices. We've seen a lot of news stories about how rent is already coming off its peak, again, mostly in Toronto. But basically, all this to say is now that the new immigration targets are here, we're essentially expecting immigration, and we've already started to see immigration kind of flatline, if not be a little negative. And so we again see a lot of that pressure coming off of rental prices as well. Now, turning to one of the major themes of the economy, inflation. So we touched on this a little bit, but of course, inflation rose very rapidly, very quickly, multi-generational highs of about 8% in Canada up until 2022, which is when the Bank of Canada started raising rates to cool demand coming out of the pandemic. That worked. Cooled demand, cooled economic growth, interest rates are really high, nobody wants to spend, nobody wants to invest. Economic growth is slowing, but so is inflation, right? So it's been a pretty good news story on inflation. And actually for the past 6 months, until February, for the past 6 months, inflation came down from that peak of 8% back to or below the target, the Bank of Canada's target, which is 2% inflation. So it was a pretty good news story, a success story. If not, we were a little bit worried, is inflation going to undershoot the target? Did we do too much? Are people, still struggling with high interest rates? Should we be cutting even more? But then in February, which is the latest data we have on inflation, we actually saw the inflation rate jumping to 2.9%. So that's right at the top end of the Bank of Canada's comfort band, which is 1 to 3%. So the Bank of Canada is, again, worried about inflation being too high. And that's actually expected to go even higher in March, because March is the first full month that we've had since the GST, HST sales tax holiday came off. And so we can expect that 2.9% to go even higher. Again, the Bank of Canada is very worried about that upside risk to inflation. But then once we move on in time, we've got April. April brings with it zero consumer carbon tax. So that's going to push down inflation. But then we have tariffs, which will push up inflation. So all of that to say, again, very, very complicated to figure out where exactly underlying inflation is. But that's something that the Bank of Canada is paying very, very close attention to, because that is their mandate. They're trying to target inflation sustainably at 2%. They frankly don't really care much about anything else unless it's a major shock, like something like a recession. Those would be the kinds of situations where something else would take precedent over inflation. So like I said, we are expecting a recession, so we are expecting something else to take precedence for the Bank of Canada. But the fact is that if inflation does continue to kind of be a little bit hotter than the bank wants it to be, that's going to limit exactly how much they can continue to cut. So like I said, just kind of bringing things back, we are expecting the bank to continue cutting. But again, this could change, and in fact is probably being changed right now, because they have two things that they're looking at right now. One is this inflationary impact. It's already stronger than they want it to be. It's probably going to go up further. Again, tariffs are going to push it up further. Then we have this economic impact, right, of the economy slowing down. And in fact, they actually cited the tariffs in their last two meetings. So the last two meetings, they decided to cut interest rates. The policy rate is now at 2.75%. So the last two times that they cut, the reason that they cited was this risk from the trade war, right? Otherwise, they might not have cut. And so now we're getting to this point where Liberation Day came and went. We actually came off relatively scot-free. And so, yeah, if things aren't getting a lot worse, does the bank need to cut even further? That is the question of the hour. Unfortunately, I do not have a crystal ball to be able to tell you. What I can say is right now we are expecting three more cuts to bring the rate back down to 2%. One kind of major takeaway is regardless of where the interest rate actually stops, whether they cut 0 more times now or 3 more times or even more times, it is important to remember this main takeaway, which is that we actually expect interest rates to stop falling and to remain higher than they were during the pandemic. That shouldn't be a major surprise because pandemic interest rates were near 0. That was a historic low. But essentially, we're in this era, yes, of crazy uncertainty, don't exactly know where we're going right now. The bank doesn't even know where it's going right now. It is very, very hard to figure out where exactly interest rates should be. But what I think most people can agree on is that they will be higher than they were during the pandemic. Finally, last thing we're going to touch on, I just have this slide in here because we get a lot of questions about the election. That is probably the next date of note is, of course, we have this election at the end of the month. We get a lot of questions on who we think is going to win. We don't actually have that forecasted. We are not political science people. We're economists. We are, in our forecast, we're just kind of expecting status quo until we get a change in the prime minister or a change in the government. I think it's pretty clear to anyone who's paying attention that there's really two front runners in the Liberals and Conservatives right now. We also get a lot of questions on who's better for the economy or who's worse for the economy or what's the economic impact if so-and-so gets elected. I will say, to preempt any of those questions, we're waiting until we actually get party platforms, which we don't have yet. So it's still very early on. Again, we are expecting status quo, but we're watching this quite closely because, again, who wins can drastically change the negotiation context with the United States. We all kind of know that the U.S. trade war is kind of the only real topic of this election. Not that nothing else matters, but of course that is the thing that people are thinking about primarily when they're trying to decide who to vote for. And we also know that President Trump makes a lot of decisions based on, what he thinks about people or about countries. And he makes a lot of those decisions based on who the leader is. And so that will be something to watch as well. Now, finally, I did talk a lot about how uncertain everything is. I did talk about how hard it is to make forecasts. So we have this slide in here just to show we're not really looking at numbers in particular. We're not looking at, if growth is exactly 0.5% this year, whether it's a little bit higher or lower, doesn't really matter. I mean, if you think about it, for your clients, you're not necessarily going to change your mind if growth comes in at 0.5% versus 0.1 or, what really matters is where the risks are. And so that is kind of the important way to look at it. As we are in this era of very high uncertainty, it's less about being precise, it's more about managing risks. And so we have here kind of risks for some very important pieces of the economy, where green is good and red is bad. It's not necessarily up or down, it's more good and bad. So something like growth, major downside risk, right? Something like inflation, some downside risk, but what that means is inflation could go higher, which is bad, which is why it looks like it's going down. But for your purposes, interest rates going down, likely to go down further on net. That's where the risk is that it continues to fall, and so that is good news. Real estate, possibly some neutral after, having this, period of concern, period of, potentially waiting on the sideline. Some potential support in real estate as rates fall further. If they fall further, again, really depends whether we see a recession or not, because yeah, rates could fall, but if people are losing their jobs, they might not be able to afford a house or a condo, things like that. So that is kind of how we have all of this framed in an era of very, very difficult uncertainty, very, very hard to be able to forecast. I'll leave the slide here just as the main takeaways as I kind of wrap things up and open it up for questions. So yeah, thanks for listening. Hopefully I was slightly more entertaining than your high school economics teacher. Should I pass this around? Thank you.
There was a recent policy change that BMO came out with as it dealt with business for self that are tariff sensitive, where it almost seems like there's another layer of stress testing those individuals. And it seems like BMO is front of the line with all the majors. Do you see other majors following suit with similar policy guidelines?
So I'm not part of that kind of decision making, let alone at BMO, let alone at the other banks. But I will say, I think, yeah, broadly speaking, there is this additional stress. I think it's kind of a reflection of the fact that, again, not everyone's going to experience this trade war in the same way. The people who are getting hit the hardest are those auto workers, the steel workers, those aluminum workers. And so it's really a reflection of that broader landscape. And because it is so broad, I can assume that, you know, it's not just going to be a BMO question. It's going to be kind of a more Canada-wide situation. But again, I can't, unfortunately, I don't make those decisions myself. Yeah. We've got a question over here.
Thanks, Shelly. I'm wondering, do tariffs have a limited life? Like in terms of, are they a short-term fix? Because as the other countries start retooling and looking at different sources to export, doesn't that diminish the tariff base, and then eventually that no longer becomes a tax revenue for the government, and now they have to do something else?
That is a very great question, and is kind of underpinning the whole, how long are these tariffs going to last, / are we in a recession, all of this, right? One interesting aspect of this is what exactly is the goal of the United States government, right? We've heard conflicting things. One major reason that we've seen is, you know, they're trying to bring investment back to the United States. They're trying to bring manufacturing back to the United States. Of course, like you said, is if we start seeing countermeasures from other countries, that kind of diminishes that. But sure, like I said, you know, potentially more companies are going to start thinking about investing in the United States over the long term if these tariffs last. Sure, okay, that is one argument. But then on the other side, okay, if people start responding to those tariffs by bringing the jobs back to the United States, by bringing, you know, U.S. consumers, for example, buying U.S.-made goods instead of, you know, Chinese-made goods or Canadian-made goods, that means it's working, but then, of course, then the government is collecting less revenue. So if one of the arguments for these tariffs is government revenue, then those two are kind of at odds with each other, right? So that is one reason why we're not exactly sure. But another aspect here is also, to what extent can other economies counter these tariffs, right? The United States is the most, is the biggest economy. Of course, it has military strength as well that it can use. There are very limited countries that can actually respond in a way that would, you know, make them take notice. Canada is doing its best. I would say it's probably, relatively speaking, being the most aggressive out there, because we have faced not just these tariff threats for a number of months now, but of course the government's also citing these threats of annexation, right? So we've been quite aggressive. We can't keep up, right? We're a much smaller economy. I think everyone knows that, right? But there are other areas like the European Union, for example. So all together, if they all work in sync, which is its own whole problem, but if all the countries in the European Union work together, they're about the same size as the United States. So they have a lot more firepower, and they're already also being a lot more aggressive in terms of their threats of action. So if they follow through on that, again, then that could potentially lead to the U.S. backing off. We've already seen the president backing off a number of tariff threats, putting them on and then taking them off. So it looks like there's some room for removal. But again, I think it all comes down to this question of what exactly is the goal here, which is very difficult to kind of interpret even for us on the outside, but it seems like even within the White House as well. So, yeah.
Hi.
Hi.
With inflation rising, we know bond yields will also react. And on what will drive our Bank of Canada to make sure that they are still cutting rates and helping Canadians? Like inflation is still going up, but what could be the factors that they can still cut the rates?
Yeah, so ultimately it depends on inflation at the end of the day. So if inflation is going up, they might not cut, like I said, and like you alluded to. If they do cut, it will likely be because the economy is crashing or slowing down so meaningfully that overwhelms that elevated inflation. And so why that would be? It's because, okay, so the Bank of Canada targets inflation, but if inflation is kind of a lagging indicator as well in that it's reflecting past interest rate hikes, past economic strength. And so a lot of the reason why inflation is strong right now is because, again, the economy was actually doing pretty well. Demand was recovering, things like that. And rates were falling in the past, right? So they're trying to look ahead so that they can target, future inflation based on past data. And so that's where things like a potential recession come into play. Because if the economy does slow down very meaningfully, and if it does, in fact, potentially contract in some areas, then that means that future inflation will fall much further, right? And so they would try to preempt that and try to cut that in response. And so that's where they're trying to figure out exactly how much risk we have from tariffs. So like I said, the last two cuts were because it was meaningful risk, right? And when we're looking ahead to the April meeting this month, the things that have changed in the last month haven't been that bad, because the main thing was, yes, there is a new tariff on autos, but again, we didn't get that minimal tariff on Liberation Day. So, that's when things get a little bit more murky in terms of, are we actually going to cut? We do know that they talked about pausing in the last couple of meetings. So it will be on the table for this month's meeting, and I'm sure for other meetings as well. But it's really, I think, a question on how much of this trade war escalates is going to be what determines whether they cut or not. Yep.